Howdy everyone and welcome to my channel. Today I'm going to talk about how to pick index funds for a diversified portfolio. Since last month, there have been a number of rough days in the market for all of the growth investors out there. My Robinhood portfolio contains mostly individual stocks, and the holdings are heavily biased towards disruptive technologies like cloud computing, e-commerce, clean energy, and electric vehicles. During a particularly red day in February, I logged in and saw I was down 7%. It was so painful. Even though there was a bit of a rebound throughout the day, I still closed at a 3% loss on that day. Since then, some stocks have fallen, risen, and in some cases fallen again. At times like these, it's so important to first of all know that you can't time the market. Equally important, at least for me, is having a diversified portfolio that aligns with your risk tolerance. Before we even discuss building a diversified portfolio and managing your risk, we need to talk through some prerequisites. Are you able to save after paying your monthly expenses? You need to be able to add to your savings on a monthly basis. It's not enough to just break even, let alone spending more than you earn. Additionally, having a 3-month or more emergency fund is important because it helps minimize the likelihood that you'll have to sell your investments at a loss if you need the money. March 2020 was really informative for me personally because when the market crashed, I had enough cash on hand and I also was lucky not to lose my job. If I had invested all of my savings in the stock market and also lost my job at the same time, I definitely would have been in a very tough spot. One approach you can take to deciding how you want to structure the investments in your portfolio is by considering your risk tolerance. When I speak about risk tolerance, it can be hard to actually understand what it means in like a concrete way, right? So the questions you want to ask yourself are like, what is your time horizon, right? How long are you looking to invest? Is that some money that you'll want to withdraw in 5 years? Or are you saving for retirement, which is 30 years away, right? You also want to ask yourself, like, how would you react in the event of a major global market downturn? Would you feel tempted to adjust the risk in your portfolio? And how much market loss do you feel like you can withstand in any given year? 5%, 15%, 25%? And percentages can feel really abstract as well. So be sure that you make it kind of more concrete for yourself, right? So if you have a $50,000 portfolio, that would be $7,500, right? How would you feel about that kind of loss? You don't necessarily want to panic and sell off everything when the market has a dip, but at the same time, you do want to understand the risks you are taking. Here are some sample investment mixes from Fidelity. Notice how all 4 examples include US stock, international stock, and also bonds. These are the core asset classes you may want to consider including in your portfolio. Since bonds are considered more of a conservative investment, they are featured more heavily in the lower risk portfolios, whereas stocks have a greater share of the asset mix for investors pursuing aggressive growth. And then also let's talk about market capitalization. So market capitalization describes a company's worth according to the stock market. When it comes to investing in US stocks, you want to have exposure to large cap, mid cap, and small cap companies. Large cap companies represent the largest US companies. These are entities like Microsoft and Johnson & Johnson, which have market capitalizations or a market value of $10 billion or more. Mid cap companies like Chipotle and Twitter fall between $2 billion and $10 billion. And then to be a small cap company, the company needs to have a market cap between $300 million to $2 billion. Crocs and FICO are both examples of small cap stocks. Let's say my target portfolio is similar to the aggressive growth option. I'd want to invest 65% in US stock and 25% in international stock. In order to generate income in the portfolio and also increase diversification, I'll target 5% bonds and 5% in real estate investment trusts or REITs, which yield higher dividends than the average US stock. Now let's head to Fidelity's Mutual Fund Screener to look for funds to create this portfolio. If you go to fundresearch.fidelity.com/fund-screener, you can get to this page, and basically it just helps you do research on mutual funds broadly. It's not specific to only Fidelity funds, But this video will be focused on Fidelity funds because, as you can see, there are 3,434 funds, and that would be a lot to cover in a single video. So we'll restrict our search to Fidelity funds. First of all, we want to find our small cap mutual funds. For asset classes, we're looking for US equities or US stock. Here they just have a warning reminding you that stock markets are volatile and it involves risk. So now under categories, we're going to look at all the small cap funds. So for blend, growth, and value. Under management approach, there's the option for all, and which we'll do just to sort of see. But active funds that are actively managed means that basically there's a fund manager who is responsible for actively trading stocks in the fund to yield the highest results. Funds with an actively managed approach tend to be more expensive in terms of the management fees associated with those investments compared to funds that are specifically index funds, which means they are passively managed. So the fund manager basically just tries to match the performance of a particular segment. They don't try to necessarily beat it. Personally, when investing, I prefer index funds to actively managed mutual funds. Since we want to just see what all options are out there, we will not select any filters related to the Morningstar ratings either. So here are the 9 funds. We'll go ahead and click hide over here so we can see the whole table. Yeah, personally, I like to order things by expense ratio, where the fund with the lowest ratio is towards the top, and an expense ratio is just like a management fee. It's associated with an investment. It takes care of the operational cost of managing a fund, and that's not like, and that money just kind of comes out of the fund. So before you ever see your returns, that expense ratio is kind of already calculated in. There are 9 options here. Some are blend, some are value, and some are growth. We can see that the small cap index fund FSSNX has the lowest expense ratio of 0.026%. And then, and it looks like it's been around for more than 5 years, but less than 10. And over the life of the fund, it's returned an average of 14% every year, which is like pretty good, particularly given that it is an index fund. As opposed to being like an actively managed fund. We have FECGX, which I actually invest in. So it's a small cap growth index fund. It was created within the last 3 years, so there's kind of limited performance information available for it. And that's also why there's not like a Morningstar rating for the overall kind of quality. When investing, something that people always say is that past performance is not an indicator of future performance. Obviously, like, it's really tempting for me to like look at this and kind of just go with the, the thing that has the highest returns, which, maybe I look at the over life of the fund and I'm like, wow, this is 31%, but it's only for, less than 3 years. But at the same time, there's less than 3 years of data compared to maybe a fund that's performed really well this year, and there's more data available for it. If I were looking at this page, trying to decide on a fund, I would probably go with one of these top 3 just because the expense ratios are pretty low. Personally, I try to go really as low as possible. I try to stay under like 0.08%. Yeah, after that, it's kind of up to you. Like, some people, feel more comfortable with funds that have been around for longer. So then the small cap index fund, FSSNX, would maybe be of more interest. Some people want to focus on growth, and then others want to focus on value. We can also take a look at some of the other performance metrics, but before then, let's actually look at each fund to see what is actually in it, right? So if we go here, this is kind of the research specific to this mutual fund, and we can look at composition. So it shows us the weight of each sector in the fund compared to the Russell 2000 index and kind of how it maps. So obviously, as it said on the other screen, this is a small blend fund with mostly United States equities in there. The top 10 companies. I haven't heard of most of these before. And a lot of times when you're investing in small cap companies, because they are the smallest companies, you might not be familiar with all the companies represented. Looking at this, I think I only recognize maybe two of these. Plug Power, I think, is an electric vehicle battery company, and then Sunrun, it would be a solar energy company. So there's some clean energy stuff in here. This has 2050 holdings as of the end of last year. So now let's take a look at the composition for FECGX, which is a small growth fund. Again, we'll go here to the composition tab. We can take a look at how the fund compares to the Russell 2000 Growth Index. So notice that the previous fund we looked at and this one are actually compared to different indices, right? Again, I don't recognize any of these companies except Plug Power and Sunrun, but I think it's actually pretty much the same top 10 holdings, right? Okay, no, they're not exactly the same, but that's also something to think about. So this fund has like half as many companies represented as the blend fund, right? So instead of 2050, it has 1,129. Again, but for both of these, the top 10 represent like less than 7% of the portfolio. So that's something to keep in mind. All right, now let's take a look at the last fund, the value fund for small caps. And we can just go to the composition here. Again, notice that this is a different index, right? So one was compared against, the blend fund was compared against the general Russell 2000 index. The growth fund was compared against Russell 2000 growth, and then this value fund is compared against the Russell 2000 value index. Now again, we can go down to the top 10 holdings. Here we have top 10 represent less than 5% of the total portfolio. It has more holdings than the growth index and less than the blend, which makes sense because the blend fund would have both the growth holdings as well as the value holdings. It's still pretty diversified. Some of these companies do look familiar, like Darling we saw in a previous fund, as well as Penn National Gaming was also in the blend fund, as well as CZR. I think those were the only ones. If you wanted to see a more complete list of the holdings, you could click like the monthly holdings reports. And so this is as of the end of January. You could literally find each one of the companies that this fund is invested in, the amount of money in terms of market value that they have, and the percent of the overall portfolio that it has. This is like nearly 30 pages long. I won't bore you with this, but if there was ever any interest in your end, this is kind of how you could maybe see what kind of companies were in a fund outside of the top 10 holdings. But we also want to take a look at the risk. So the risk for all of these funds is the same, right? Which makes sense because they're all small cap funds. They're all 100% US stock, sort of things like that. I'm not too familiar with the Morningstar risk kind of methodology, but I could see it making sense that these all have similar risk profiles. Standard deviation is a measure of volatility. In this particular case, it's measuring how the rate of return tends to deviate from the average. When you look at standard deviation, it's important to understand that the greater the value for standard deviation is, the greater the range in past returns is, right? The range of past returns is going to vary greater with FSSNX over here with a standard deviation of 25.68 compared to the small cap growth fund FCPGX with a standard deviation of 23.33. But again, these are still generally in the same kind of range. Though past performance is not a guarantee for future returns, standard deviation has been a strong indicator of future performance in a mutual fund. So that's something to keep in mind. Let's talk about the Sharpe ratio. So the Sharpe ratio is a metric for understanding risk-adjusted return. In short, it describes how much excess return you receive for the volatility of holding a riskier equity. So it's kind of answering the question, was the risk worth it? Beta indicates how volatile a stock's price is in comparison to the overall stock market. Stocks with a beta above 1 are considered high, whereas stocks with a beta of 1, that means that it tracks with the market, and then less than 1 means that it's less volatile than the overall market. And then finally, R squared is a measure of the percentage of an asset or mutual fund's performance as a result of a benchmark. So it's kind of like how closely do they track with the benchmark. Now let's take a look at management and fees. So some people find it really assuring when investing, like that, hey, the fund manager or the fund itself has had like a long history of performance, and that kind of gives them some comfort. Um, so like I previously noted, a couple of these funds, the lower cost value and growth options are newer, so they were created in 2019, and that is also probably the reason why they have a lot less in assets in them, because they are newer. As far as turnover rates, a turnover rate is the percentage of the fund's holdings that have changed during the past year. So when a mutual fund has a high turnover rate, it increases the costs bared by investors, because the cost for the turnover is taken from the assets funds, and that is in addition to the expense ratio that you're still charged. So all of these have a minimum investment of $0. That's one thing that Fidelity is pretty good with, compared to maybe other companies like Vanguard, where a lot of Vanguard's funds you have to have $3,000 as your minimum investment for mutual funds. And then these are all no load funds. A load fund is a mutual fund that comes with a sales charge or a commission. The expense ratio is kind of like the management costs associated with having the fund. NTF means no transaction fee, and that's another kind of expense that investors can incur. But these are all not charging you transaction fees. And Fidelity's Fund Screener tends to automatically filter out funds with transaction fees. Let's take a look at Morningstar rankings. We have our 1 year, 3 year, and 5 year rankings. Morningstar seems to really like FSSNX, so that's kind of, something that you can think about. What do these numbers mean? Golly gee, I have no idea. Oh, wow. Let's look here to the help me read this table to better understand what we're actually looking at. The 1 year rank, 3 year rank, 5 year rank, and 10 year rank all have pretty much the same explanations, and that's it. It displays how a fund's returns compares to other funds within its same Morningstar category over a 5 year period. And that ranking is expressed as a percentile, so lower numbers indicate better performance, right? So lower is better. It's also important to note that when we talk about Morningstar category, that means that we're comparing this fund to this fund and this fund and so forth, right? So it's also really interesting to think about the fact that all of these funds down here are the more expensive funds, but that doesn't necessarily correspond with the quality or performance of a fund, right? So that's why I tend to focus on lower cost funds. Let's go to income characteristics. I think this would apply to bonds for these kind of things, but we can take a look at the last dividend. This doesn't really tell us that much though, because dividends have to be understood in context with what the price per share is. So it would probably be a more helpful metric to, instead of having the last dividend as a dollar amount, having it as a dividend yield, so a percentage. That way it kind of takes into account the overall price per share compared to the dividend, because otherwise, just in context, we can't really understand this. Let's look at short-term performance. So again, it looks like one of the funds performing the best this year so far. Granted, we're less than 3 full months into the year, but it's a fund with one of the lower expense ratios. Daily pricing and yields is basically just tracking how the changes in the cost per share. So this is an explanation of the steps you can take to vet a mutual fund and choose the best one for your portfolio. Let me know in the comments which one appealed to you the most. Would you go with the small cap index fund, the small cap growth fund, or the small cap value fund, or even one of the other ones? Thanks for tuning in.